Last week was a strong week for the S&P with a lot of companies in the green, as we can see. And in today's episode, we want to find 6 undervalued dividend stocks near their 52-week lows to buy with some significant upside. We'll look at every single one. We'll run through their historical performance. We'll take a look at their dividend safety, as it is important, especially for those with higher yields that we'll look at today. We'll run through a lot of underlying metrics, their free cash flows, their ROICs, their debt levels, and we'll run every single one into the valuation model, getting to our intrinsic value, finding our acceptable buy price given that all-important investor margin of safety, and we'll also look towards Wall Street to see what their price target is and what percentage upside we can be expecting. So the first undervalued dividend stock near its 52-week lows, we have CVS Health Corporation. Now, as we can see, down 20% over the last 12 months. We do note it is right there towards its 52-week lows, and we can see one buy rating from Wall Street, whereas the other two analysts do give it a hold. We can see that it has a forward yield of 4.77% and a forward P of 7.97. Now, when we take a look over the last 10 years, we do see it is down negative 27%. Bear in mind, if you do reinvest those dividends, it would be slightly higher, although not a great return over the last 10 years. But do bear in mind, past performance is never an indicator of future performance, and we do see it was sitting around $109 around 2 years ago. So in terms of the dividend safety, we do have a score of 80. It does look to be safe. Market cap just over 70 billion. It does look like a large cap company, and we can in fact see their safety score was downgraded just a few days ago. It is still sitting at safe, and we can see a dividend cut does look to be unlikely. Now, in terms of the last recession, these are just a few key metrics from that period. They did in fact increase the dividend during the 07-09 crash. They had negative 2.5% recession sales, although do bear in mind this was above the average growth of the S&P. At that time, it was sitting at negative 12, and they also outperformed negative 38% when the S&P during that period brought in negative 55%. Now, dividend growth, it was actually very strong in December 23, not too long ago, 9.9%. And on this channel, we do advocate for a minimum of 4% just to keep up in line with inflation. So nice to note that over the last 5 years. But over the last 20 years, it has been very strong, 16%. They have been increasing those dividends at a very good rate. However, we do note they only have 2 years of consecutive dividend increases with 27 years of paying a dividend without a reduction. Now, in terms of dividend yield theory, for those that are new, it just states a company is undervalued when the current yield sits above the 5-year average. So right now, we do see that undervaluation signal, 4.77 versus 2.89. And we also have another undervaluation signal, so a double undervaluation in today's episode, 7.7 forward P, the 5-year average of 9.9. And we also note it does sit significantly lower than the healthcare sector P of 16. Just bear in mind, we don't look at any of these models in isolation, and we will conclude towards the end. Free cash flow payout, we do draw your attention to that. Earnings, as always, susceptible to manipulation by management through accounting. My blanket rule, below essentially 60%. If you want to be industry specific, for consumer retailers, below 40%. The reason we have these targets is just to give us faith that management have that ability to offer those double-digit increases we love to see. Nice to note, over the longer term, it has been below 40%, and whilst we note 30% in 2023, the expectation in the full year of 24 is that it is going to increase to 38%, still significantly low than that 40% for consumer retailers. We then draw your attention to the free cash flow per share. As always, we do want a company that increases its free cash flow over the longer term. $5.17 in 2014, $8.09 in 2023. So it has increased, although very inconsistent. And we do want to point out that it is expected to fall into 2024 at 6.92 per share. Sales growth, as always, 3 to 7%. That's really sort of the baseline we want to see. Very impressive. CVS Health, for the large part of the last 10 years, double-digit growth to their top line. Last 2 years at 11%, making it looking good. In terms of their sales, then numerically, we can see that over the longer term, it has more than doubled their top line, going from 139 billion to 357. And whilst we like to see companies that return excess cash through those share buybacks, we can actually see over the longer term, the net position would be net dilution going from 1.17 to 1.28, something just to factor into your own investment thesis. As always, ROIC, one of my 7 golden dividend metrics. I personally want to see 10% or more, just to give me faith that management are able to effectively allocate their capital. Over the longer term, it's been very inconsistent. The last few years, around 9 to 11% does look good. Hopefully, we can see them increase it back to the levels we saw in 2014 and 2017. We then move on to the margins, very important for consumer retailers above 10%. Now, this is a little bit of a worry. We do notice it has gone down, so some operational inefficiency. 2023 at 4%, trailing 12 month at 3%, definitely something to keep an eye on. The same can be said for the free cash flow margin. We do ideally want to see 6% as a minimum. We do note it has started to come down 3% in 2023, so something again to keep an eye on with CVS Health. We then move on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. As always, this does correlate to both balance sheet strength as well as dividend safety, below 3 for consumer retailers. And remember that these numbers below do signal the number of years it would take the company to pay off all of their debt net of cash on hand. 2023, 2.94, so it is below that 3. Just to point out though, it is expected to go up slightly in 2024 to 3.27. So again, not massively above our target of 3, but just something to consider. Although we do note that the free cash flow payout we saw above is fairly low at just under 40%, so that dividend does look to be safe for now, and the balance sheet does look okay. As always, let's jump into the valuation model. If you enjoy the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, in our deep dives, we do run through every single one of these models. Today's episode, we're running through 6 undervalued stocks. Let's get straight into the calculation. And the intrinsic value for today's episode is $66, which is the average of Graham's, the DCF, and the dividend discount model. So the current price at just under $56, we always start off with a margin of safety of 10%, and we only execute on that if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you were to believe this for CVS Health, it would be a buy, as we can see, at around $60, and then we keep going till it's near essentially the MOS of the current price. It isn't quite there yet at a 20% margin of safety, so in today's episode we do see between a 15 to 20% level. And when we take a look at Wall Street and their expectation, well, over the next 12 months, as we saw earlier, they do believe it to be a buy. Their price target is just under $77, significantly above our intrinsic value, showing 38% implied upside. And as always, do let us know your thoughts about these stocks as we run through them today. Now, before we do jump into the next undervalued stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on that pinned comment below to sign up. We do want to draw your attention, however, to this article here. For those that continually ask what are the websites, the resources we use for our stock analysis, we do write down all the websites and resources in this article, so do go check that out. The next stock we are taking a look at is Albemarle Corporation. Now, this one is down 33% over the last 12 months, as we can see right there towards their 52-week low. We have a double buy signal seeking alpha and Wall Street. On a forward yield basis, 1.23%, and on a forward PE, just under 39. Now, if you've been a shareholder over the last 10 years, you would still be up around 92%, but we do know all-time highs sitting there at $325 at the back end of 2022. Now, in terms of dividend safety, well, a 90 score, very safe. Market cap 15 billion. It is a large cap company. And when we take a look at the dividend safety, it did get downgraded from very safe 99 to still very safe 90. And we can see a dividend cut does look to be highly unlikely. So in terms of the last recession, well, they did in fact increase it during 07-09. They had below average growth and they did marginally trail the S&P, negative 63% return. Now, we are still waiting on a dividend growth, and we can see over the last 5 years, they have increased it by 4%, and over the last 20 years by 9%. We know they are a dividend aristocrat. They have been increasing those dividends for more than 25 years. When we take a look at dividend yield theory, then we do notice a undervaluation signal on the yield, 1.23 versus the 5-year of 0.97. However, we do note the forward PE does sit higher than the 5-year average, as well as sitting higher than the materials sector of 19.4. So let's take a look at other metrics. Well, what we can see here is when we take a look at their free cash flow payout, we do want to see it below 60%. And we can in fact see here that whilst the data doesn't look to be updated for the previous 10 years, 2024 expected to be 16%. So that is very low, and there are no real worries with that. We can understand just off of this information why that dividend does look to be very safe. Now, free cash flow, one thing to note, over the last 10 years, they have suffered. We can see, in fact, from 2018 to 2023, it has been negative, although we do expect them to turn positive in 2024, and we can start to understand why that share price has been pummeled very strongly just even over the nearer term. In terms of sales growth, well, 3 to 7% over the last 2 years, very, very strong double-digit growth, in fact, triple-digit in 2022. Prior to that, we do note some inconsistencies with some years of negative, but in fact, over the longer term, this is a company that if you have been investing in a long time, has been growing at a very rapid rate. We can in fact see here around 4 times growth from 2014's 2.45 billion to 2023 9.62. Now, what you'll also note is they would have diluted your position over the longer term, going from 79.1 million shares to 118, so something just to factor into your own stock analysis. In terms of the ROIC, well, over the longer term, we do see it around that 10% we want to see. 2022, 21%, although we can see 2023, it has dropped down to 3%, so something we would advise just to keep an eye on. In terms of looking at the margins, then we can see over the longer term, above 12%, 2022 very high, 2023 it has dropped considerably, so that is one thing that we would want to keep an eye on, because historically they have performed very well on the margin. So is this a one-off, or is this something that could continue over the next few years? Free cash flow margin, we did notice above, they were free cash flow negative for many years, hence why we do see the negative here. Their last positive year coming in 2022 at 9%. We then move on to the net debt to EBITDA, and what we can see pretty low, 1.03 in 2023, and even though it is expected to rise in 2024 to 1.2, we can understand why that dividend does look to be very safe. The free cash flow payout is very low, their net debt to EBITDA is very low as well, so that should continue over the foreseeable future. Now, in terms of the valuation, let's jump in, and as always, you can grab a copy of this valuation model below to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list. So intrinsic value 16820, margin of safety, as always, we will start off with 10%. Does look to be about up to 151 if that suits the criteria. Remember those 3 marks that we did talk about earlier. And then we just keep going until it's near that current trading price. And we can see whilst it isn't at a 25% MOS level yet, it does currently sit between 20 to 25, again depending on what your acceptable buy price is and the margin of safety you are comfortable with. In terms of Wall Street, well, this is one that they do believe has some significant upside. Their price target over the next 12 months is $172, marginally higher than our intrinsic value, 33% implied upside, making this a strong contender for one to think about for the portfolio. But as always, do let us know your thoughts below. We then move on to a company we have not reviewed yet on the channel. It is the Toronto Dominion Bank. We can see a double buy rating, Seeking Alpha and Wall Street, not too far off the $50 52-week low. And we do note on a trailing 12-month, the yield sits above 5% and on a forward PE just below 10. Now, over the last year, you would be down around 8%. If you have, however, been a long-term shareholder, you would be up around 19%. And we can see all-time highs around 2 years ago at the $85 mark. In terms of dividend safety, well, it is a safe score of 70, market cap just under 100 billion. It is a large cap company, and we can in fact see they were recently downgraded to a 70 score safe, but still the dividend cut does look to be unlikely. Now, in terms of those key metrics, we can see there are a few here. In terms of recession sales, well, pretty much flat. We do also note they did marginally trail the S&P with their negative 63% return, but they did maintain the dividend during the last recession. They didn't increase it, but they also didn't cut it. Dividend growth looking fairly positive in my opinion, especially with a yield of around 5%, 6.3% increase last November, 8% over the last 5 years. double digits over the last 20 years, and whilst they only have 13 years of consecutive increases, they have been paying a dividend for 167 years without a reduction. Now, in terms of dividend yield theory, we can see here a double undervaluation signal, 5.31 versus 4.24. We also note on a forward P, 9.9, it does sit below 10.7. And when we look at the financials, 11.5 for the sector, it is marginally higher. So in terms of looking at the metrics, now what we can see here for free cash flow, it isn't something that is relevant for banks. So we draw your attention to the earnings, ideally around 40%. Now for TD, we have seen it struggle and in fact straddle around that 40%, slightly higher. 47 in 2023, 52 expected in full year 24. Not a red flag indicator, but just something we would say to keep an eye on. Hopefully it doesn't continue to increase year on year. In terms of earnings per share, well, similar to when we look at free cash flow, we do want consistent increases. It has nearly doubled over the last 10 years, but do note the inconsistencies year on year and the small drop expected into 2024. In terms of sales growth, well, we can see here around that 3 to 7%, 3%, so the lower end in 2023, but we do note on a trailing 12-month basis, it does look like for the full year it should be higher. Now, in terms of the total sales, well, we can see here 28 billion to 49.2. And in terms of shares outstanding, yes, the net point here is essentially share buybacks, but very minimal over the longer term. So not too much to talk about there, fairly trivial. In terms of looking at the return on equity, which we prefer over ROIC for banks, we do see it is above that 10% we like to see for the majority of the period. 10% their lowest point in 2023, trailing 12 months at 11%, so fairly positive when we do take a look at that metric. Now, operating margin, as well as the net debt to EBITDA, as well as the free cash flow margin that we do typically look at for the majority of companies, as we can see here, it isn't meaningful as for banks' interest is a core component of their revenue and expenses. So let's jump straight in then to the valuation of Toronto Dominion. Let's get to the intrinsic value, which in today's episode is the average of these three models, coming to just under $69. Now, with the current price of around $57, the margin of safety of 10% does take it to a buy up to $62. And then we keep going till the current price or near enough. So not quite at a 20% MOS level, somewhere between a 15 to 20% based on today's episode. When we take a look at Wall Street and their expectations over the next 12 months, well, they see upside of 17%, price target of $66, as well, not too far off our current price, and it isn't a bad one for the portfolio to consider. You are getting a fairly nice starting yield. They have been paying dividends for a long number of years, so let us know below if this is one that is now on your watch list, or maybe one historically you have had in the portfolio. We then move on to the next stock, which is Pfizer. Now, as we see here, a double buy rating. It does now have a yield bang on that 6% level and a forward P of 12. Now, over the last year, they are down 27%. If you've been a shareholder over the last 10 years, you would be up 1.54%. And we do see all-time highs sitting around the $60 mark at the peak of COVID, and that was nearly 3 years ago. So in terms of the dividend safety, 75 score, it does look to be safe. Market cap, 159 billion. It is a mega cap company. We in fact see their dividend safety score was just reaffirmed not too long ago, with a dividend cut looking to be unlikely. Now, last recession, we do know they did in fact cut the dividend. They did have slightly higher than average recession sales, and they did marginally beat the S&P with a negative 45% return. Dividend growth, not the greatest. The only reason I say this, as we mentioned, we do advocate on the channel a minimum of 4%. The reason that we keep saying this is because 4% was the average inflation rate in the US over the last 40 years. So if you're getting anything lower, you are in fact taking a pay cut and losing your purchasing power. And we do note over the last 5 years, they have at a minimum kept up with inflation, and the same to be said over the last 20 years. Now, they have been increasing those dividends for the last 13 years, as we can see here, the dividend cut that did take place in the last recession. So in terms of dividend yield theory, we have that severe undervaluation signal on the yield, 6% versus 4% over the last 5-year average. But we do note the forward P doesn't sit too far off there, the 5-year rolling of 12, and slightly lower than the healthcare sector sitting at 16. Now, in terms of the free cash flow payout, definitely one we do focus on a lot more. We can see it is above that 60% significantly in 2023. What this indicates is that management paid out more in dividends in 2023 than they essentially, as you can clearly see here, generated in free cash flow. When we take a look at 2024, the expectation is that it will reduce down to 85%. Still very high, but something we would say just to monitor. In terms of free cash flow, we do know that it has been downward trending over the longer term, but we can see 2023 lows of 85 cents is expected to be a very nice boost into 2024 of just under $2. In terms of sales growth, well, no surprises here. They did have a very strong boost during that COVID period. Following that, their top line did reduce dramatically, negative 42%. But if you have watched our in-depth detailed videos, you will see there are some growth catalysts moving forwards. So there we have numerically going from 50 billion to 59 in 2023. What they have also done over the longer period, as we can clearly see, are those share buybacks, nearly buying back 1 billion worth of shares. And when we look on the ROIC, very mixed, very inconsistent. Some years looking very good, some years below the 10% level. In fact, 21, 22 in the mid-20s, 23 in the low single digit. So something, again, we do need to keep our eye on moving forwards. In terms of the margins, well, very strong up to 2022 on both the operating margin as well as the free cash flow margin. Nonetheless, 9%, it isn't the worst. It's just something we do want to keep an eye on. Ideally, we want companies increasing their top line revenue as well as increasing their margins. Free cash flow margin, now even though it has dropped to 8%, it is still above that minimum 5%. But again, just some things that we will analyze when they do bring out their next quarterly and annual reports. So don't forget to hit that subscribe button so you are aware of when that takes place. Now, in terms of the net debt to EBITDA, it was significantly above that in 2023 at 3.75. The nice thing to note here is expected to come down very rapidly to 2.59 in 2024, which makes us understand why we do see that safe score on the dividend. In terms of the valuation of Pfizer stock, the intrinsic value in today's episode is the average of these two models, coming to $33.18. In terms of the current price, it does sit at the $28 mark. And a 10% MOS level indicates a buy just under $30, at 15% at 20, or in fact 28.20, and when we go to 20%, it isn't quite there yet. So in today's episode, we do see a 15% MOS level for Pfizer, and when we look at Wall Street and their expectations, well, they have a price target of $36. They do see some strong upside of 29%. Again, similar to the previous stocks we have reviewed today, a lot of buyers or a lot of contenders to think about for your own portfolio. We then move on to another stock that we haven't reviewed on this channel before. It is Whirlpool Corporation. We have 1 buy rating and 2 hold ratings. Again, right there at the 52-week low. It does have a very large forward yield, 7.4%, and a forward PE fairly low at 7.44. Over the last year, it has been hammered down negative 29%. Over the last 10 years as well, we can see not the greatest performer, negative 35, although we do see all-time highs sitting around that $250 mark. In fact, that was around 3 years ago today. So when we take a look at the dividend safety, it is a 50 borderline safe score, so let's take a look at that. 5.19 billion, it is a mid-cap company, and we can see the dividend safety was reaffirmed just a few days ago with suggestions of a moderate risk to their dividend cut. In terms of the last recession, well, they didn't increase the dividend, but they didn't cut it. They did, in fact, maintain it. They had average growth, negative 16.9, but they did trail the S&P, negative 78. And when we take a look at that dividend growth, they have just maintained it for the last year. Over the last 5 years, increases of 9% on average, and the same to be said over the last 20. Whilst they have 0 years of consecutive increases, we do note they have been paying a dividend for the last 68 years without a reduction. Now, in terms of dividend yield theory, we do note here a very severe undervaluation signal, 7.37 versus 3.72. Same could be said for the forward P at 7.3, and we also note it is significantly lower than the consumer discretionary of 12.8. In terms of the free cash flow payout, well, here is a red flag indicator, 105%. As we mentioned earlier when looking at Pfizer, management paying out more in dividends than generating in free cash flow. The positive to note here, it is expected to come down very sharply to 41% in full year 24. In terms of the free cash flow per share, well, very inconsistent. We do see it increase up to 2021, and then it has been coming down into 2023. The very positive thing to note here is it is expected to rise rapidly to 1720 in full year 24. In terms of sales growth, well, very mixed, pretty much 5 years negative growth, or in fact 6 years negative growth, 4 years positive growth, so very, very inconsistent. And when we look at this numerically, we can see their top line has barely moved over the longer term. What they have done quite nicely, though, is return a lot of that excess cash to investor pockets through those share buybacks, reducing it from just around 80 million to 55 in 2023. When we take a look at the ROIC, pretty healthy, pretty strong, around those double digits every single year. So that is a good, attractive sign for potential investors. But when we do look at the margins, it does leave essentially something that we do want to see improve over the longer term. As we can see, it isn't above 12%, is very, very mixed. And the same could be said for the free cash flow margin, although we would ideally like to see the operating margin increase. So something we will take a look at when they do release their quarterly earnings. In terms of the net debt to EBITDA, what we can see, 3.69 in 2023. It is expected to increase to 4.27 in 2024. So again, whilst we do note that the dividend safety above, it is something we will take a look at and something we should be concerned about moving forward. But as always, if this is one that you do like and in your investment thesis, that is where the valuation comes in. What is the essential margin of safety that we are getting? What is the expected upside? And whether or not we believe over the longer term, this company's fortunes will turn. So the intrinsic value just under $122. The current price sitting at $95. Margin of safety at 10%, a buy up to 111. Or in fact, 15%, we do note 103.50. 20% not too far off the current trading price. So in today's episode, we do see an MOS level between 20 to 25%. But given those metrics, it will really depend on whether or not this does fit your portfolio as a value play, one to turn around. It does also have a fairly high starting yield. In terms of Wall Street and their expectations, well, we can see they have upside of 26%. Their price target 120, not too far off our intrinsic value. So it depends whether or not for a 7.4% yield, you would like to take on an MOS level of 20% and around 26% upside over the next 12 months. But do let us know your thoughts below. We then move on to the next undervalued stock, which is Nestle Corporation. Now we have a strong buy rating from Wall Street, 4.5 out of 5. Again, we can see not too far off their 52-week range with a forward yield of 3.24% and a PE trading 12 months slightly lower than the S&P 500. Over the last year, well, negative 18%. If you've been a longer-term shareholder, you would be up, although marginally at 31%. And we do see all-time highs around $140 at the back end of 2021. Dividend safety, the highest score obtainable. First time we've seen that in today's episode, 99, very safe. Market cap, $275 billion. They are a mega cap company, and we can see just recently we reaffirmed that very safe score, and therefore a dividend cut does look to be highly unlikely. Key metrics from the last recession, they increased the dividend and they had around average growth. And when we take a look at that dividend growth, pretty poor. You know the reasons why now. It is below 4%. Last 5 years at least at that inflationary rate, and over the last 20 years at 7% per year. Now, they have been increasing those dividends for the last 23 years, so they are 2 years away from becoming a dividend aristocrat. In terms of dividend yield theory, we do have that severe double undervaluation signal, 3.24, above significantly the 5-year 2.5, and the same can be said for the forward PE, although when we do take a look, it is only marginally lower than the consumer staples sector of 19.2. When we take a look at the free cash flow payout, below 70% for consumer staples, it has straddled pretty much along that over the longer term. Nice to note, in 2024, it is expected to come down to 68%. And when we look at the free cash flow year on year, very inconsistent. Again, expected 2024 to be a strong year on that free cash flow, as well as lowering the free cash flow payout. In terms of sales growth, we do want to see 3 to 7%. At a minimum, if they're not getting the lower end of 3%, then you could argue in real terms they are in fact reducing their top line. Their best year in 2022 at 8%, although the more recent year we did see a drop of negative 2%. Numerically then we can see 92 billion to 93. In terms of shares outstanding, well, they do consistent small share buybacks year on year. Always nice to see. Remember, that is a nice bonus on top of dividend growth. And ROIC, very good. What I love about this, the consistency and the strong metric. So investors will love to see this, especially this metric as well. When we look at the margins as well, again, consistency, yes, it isn't significantly above the minimums we like to see, but the fact that it has been 17% over the last 6 years is a very strong indicator of the consistency of this business, and the same could be pretty much said about the free cash flow margin. Then finally, when we do take a look at the net debt to EBITDA, no surprises of the very safe dividend score, 2.65, significantly below 4, 2.6, not too far off the previous year expected as well. So balance sheet looks strong and dividend safety looks to be very good. Now when we take a look at the valuation, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, you can grab a copy of these models by clicking on the pinned comment below. So intrinsic value, $122. Margin of safety at a 10%. We do see an acceptable buy up to 109.68. At 15%, it isn't too far off, around the dollar. So we would say it is very near to a 15% MOS level in today's episode. In terms of Wall Street and their expectation, well, over the next 12 months, they do see some very strong upside of 26%. Their forecasted price of $132.50 as well is higher than our intrinsic value. So Wall Street do see a lot of value within this company. As always, let us know your thoughts in the comments below. Are you adding to any of these? Are they on your watch list? Or maybe you're already a long-term shareholder of some of these companies. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos. Let us know your thoughts below, and as always, we'll see you all on the next one.